And unfortunately, Bitcoin is still traded as a risk asset, even though, as you know, I think it should be traded as insurance. I'm not bigger than the market. You got to watch what the market's doing, not what you believe. So lots of ways it could happen, but unfortunately, be very clear that this is not grade 11 math from the perspective of sitting in a risk chair, okay? Trading credit default swaps is a very specific business. It's confined to the largest funds in the world. You need what's called an ISDA, an International Swaps Dealers Association accreditation. It's done between hedge funds and banks and large asset managers. It's not for the little guy, but I use the CDS markets, the credit default swap markets on sovereign debt to provide a valuation matrix for Bitcoin. It's done through a credit lens, Nat, because that's where my experience has been. I spent my entire career in credit markets, as you know, so I always start an analysis with a credit perspective. So really quickly, and I did send out a tweet, I like to think of Bitcoin as essentially a credit default swap on a basket of fiat currencies. And that is to say that you are buying insurance on the potential default of some of the currencies in that basket. Now, as we know, there have been regular defaults that have happened within particularly emerging market economies. I have yet to experience the formal default of a G7 country, but I believe that is probably coming as well. Anyway, to line up how I value Bitcoin as an insurance policy on these baskets of currencies, look at the current 5-year default swap rate on USA, and that's 20 basis points, which means that it costs you $20,000 a year to insure $10 million of debt on the USA against default. Now, many people say, why in the world would you buy protection on the USA if they can just print money and solve a default by printing more money? And the truth is, that is an excuse. Nonetheless, people still do it. I'm not going to argue with the market. The market is 20 basis points, which means people are paying that premium. Why are they paying that premium? Because they obviously think there's a greater than zero chance the USA can default. So 4 basis points a year means that over 20 years, for a period of 20 years, I estimate that the USA would be worth 80 basis points. If anyone was to sell insurance, they would get 80 basis points on that contract. And then I just take the outstanding debt of the United States, which is 30 trillion of funded debt, and another 170 trillion. So in total, Nat, there's 170 trillion plus 30 trillion, 200 trillion of USA obligations out there. And I just multiply 80 basis points by that, 200 trillion, and you come up with $1.6 trillion. Is essentially how much default protection would be worth on the entire USA. Now, funny thing is, Bitcoin only trades for 375 billion. So if my thesis was correct, and I'm not saying it is, it's just the way I like to look at it, you're getting default protection on the USA for less than 1/3 of the value. And you're getting all the other nations in the world for free. And I think a lot of people would agree with me that the chances of other nations defaulting before the USA is substantially higher. So I like to get stuff for free and only pay 1/3 the price for the USA. It was my way of saying, my God, Bitcoin is undervalued. The bigger concern that I had was when the Bank of Japan, one of the governors came out today, I can't remember who it was, and basically said, it's all fine, as I mentioned earlier. Well, chances are it's not all fine. And why is that? Because Yellen very quickly thereafter went on tape saying, oh, the USA and Japan are going to explore all ways of controlling the yen and keeping things stable, if you will. That's just another way of doing quantitative easing that Bernanke said many years ago that the way the USA could invoke quantitative easing is by participating in foreign countries' debt markets. Well, it looks to me like they are potentially going to invoke quantitative easing in Japan as some backdoor methodology of employing QE across the world, just not in the USA's debt markets. And here's the funny thing, Preston Pysh jumped on this immediately, and he basically sent out, oh, okay, so that's what the US taxpayer money is going to be used for. Is it to support the bond market in Japan? It's not pretty. An economist that I'm very fond of, Luke Groman, believes that yield curve control is the only way we can escape the debt spiral in the USA. What yield curve control is basically the central bank pegging a rate somewhere along the yield curve. Let's take Japan's case where it's at a rate of 25 basis points. They basically say they will buy all the bonds that are for sale at 25 basis points. There's a price at which they will put a stake in the ground that anybody in the world, including hedge funds that are shorting the debt to them, they will buy all that debt at 25 basis points. And it's a way of pegging a point in their yield curve to try and control the shape of the overall yield curve, but most importantly, to keep the base level of interest rates locked at 25 basis points. It's basically the IMF financial repression methodology of reducing the debt spiral. It's not good for bondholders. It's horrible for the currency, the reason you need Bitcoin. It will be some sort of event that comes out of left field, something like Russia pricing oil and natural gas in Bitcoin, something like a central bank of a large country divulging that they've accumulated a certain amount of Bitcoin and plan to accumulate more of it. Or perhaps it's nothing more than education, where people realize that every single asset in the world is being debased because of the Fed policy. Let's get on board an asset that is programmed to increase in value, whose monetary supply is written in math and code. So education's the long run. The short run would be something like an announcement. And then the real one will be, or a very potential one, is when the Fed pivots. And unfortunately, Bitcoin is still traded as a risk asset, even though, as you know, I think it should be traded as insurance. I'm not bigger than the market. You got to watch what the market's doing, not what you believe. So lots of ways it could happen. But unfortunately, there's lots of ways it could still, experience some downdrafts, no question. Look, Japan. I mean, there's all sorts of things that could happen. You already have some Fed governors that are talking back the assumed 75 basis point increase that's coming in the next 2 weeks. There's Fed governors are smart enough to read financial markets. Today's close on the equity markets was pathetic. Financial stocks took a huge gap lower at the end of the day. Business confidence is at all-time lows, literally all-time lows. This is not good for the economy. And the USA is going to have to choose whether it wants full employment or control inflation, but it's not going to be able to do both. Okay. It's always that, Nat. It's always smoke and mirrors with the Fed. They talk a big game and then they pivot because the markets and the US dollar global wrecking ball is destroying emerging markets right now. Historic losses in emerging markets. Well, when you have historic losses of capital in emerging markets, those are your trading partners. Those cause global GDP to decrease. A global depression is in the offing, and I think the Fed will pivot. I'm not certain of it because I think that Jerome Powell is not the right man for that chair. He's a lawyer. He is not a risk manager. I honestly cannot think of anything they're doing right, okay? Like, I think they are absolutely very juniors in the room. They are not listening to the markets. They are using backward-looking data, okay? Employment reports are backward-looking. They're not looking to financial conditions. They're not looking at credit spreads. They're not looking at the jamming up of financial markets. The debt situation in the world is about 3 times larger than it was when Volcker used the same tactics. It doesn't work with a global debt spiral that we're in. That we've talked about this. Someone asked that question. Total global debt to GDP is 400%. It doesn't work, okay? There is a limit that you can increase interest rates before the whole system explodes. It's like the central bankers haven't even done the math. It's very concerning. So I'm afraid I can't think of anything they're doing correctly. If they laid out that they've actually done the math, then I'd have more confidence in it. I don't believe they've actually done the math.